I welcome you all to today's session. This session would be on India's tax structure, problems, and reforms. Tax policy is a very important constituent of the overall economic policy of any country. Tax policy needs to play a very important balancing role. One, in it has to result in mobilization of adequate revenues for the government so that the government can perform its developmental and other activities. While on the other hand, the tax policy must also ensure that the entrepreneurs are motivated enough to increase their level of investments, and the laborers are also motivated to increase their work efforts. Because it is only through increase in the level of investments and work efforts that the output can grow in an economy. Tax system of any country actually consists of two types of taxes. One is termed as the direct tax, another is indirect tax. Direct taxes are mainly imposed on personal income, the profits are generated by the companies, personal wealth, and like it. Now, the key feature of the direct taxes are that they cannot be shifted. That is, the incidence of tax and the burden of taxation have to be borne by the same individual. He cannot shift the burden of taxation to somebody else. And in that sense, the direct taxes are much more equitable because while imposition of such taxes, the difference in the income levels of the persons who would be paying the taxes are taken into consideration. So, after the payment of such taxes, the sacrifice felt by the individuals earning different levels of income remains same. On the other hand, indirect taxes are such taxes which are mainly imposed on the production and sale of goods and services. The feature of the indirect taxes is that these can be shifted. That is, the incidence of taxation and the burden of taxation are borne by two different individuals. The person on whom the tax is imposed, he can shift the burden to somebody else. And in this way, this tax is not that equitable enough, because in case of such taxes, the difference in the income levels of the individuals who would be paying these taxes are not taken into consideration. People earning different levels of income have to pay the same rate of taxes. So here, the level of sacrifice undergone by the different individuals are not same. If we look at the Indian tax system since independence as it evolved, it can be observed that the Indian tax system is heavily relied on indirect taxes. That is, the taxes which are imposed on production of goods or on sale of goods at various levels, both at the central level as also those imposed by the state governments. Direct taxes are there, but they do not result in substantial revenue generation for the government. Probably it can be said that around 2/3 of tax revenues used to come from indirect taxes. Now, there are certain reasons behind such a tax structure that developed in India in the post-independence period. The reasons are embedded in the economic condition of India, which was there after independence. India, being a developing country, the average income level of the majority of the people in the post-independence period was quite low, and accordingly, they could not be taxed. Their income could not be taxed. So they were outside the purview of income tax. On the other hand, industrialization was just starting to take place, and there were not many such large companies who would be generating substantial profits that could be taxed. Thus, the base for both income tax and corporate tax was quite low. In order to compensate for this narrow tax base for the direct taxes, kept the rates of both corporate and income tax quite high. They thought that high rates would compensate for a narrow base. But it turned out to be just the other way around. These high rates of taxes resulted in huge tax evasion. And as taxes were evaded, there was very less buoyancy of tax. That is, India's GDP was growing, but direct tax revenues were not growing. So that forced or compelled the government to look at the other side of taxation, that is towards the indirect taxes. They understood, that is the government understood, that the base for indirect tax was quite a bit large, because anybody and everybody, while making any purchases of any goods or services from the producer or from the trader or from the dealer, just as they paid the price, they would be paying the amount of indirect tax which is usually embedded in the price. And thus, a huge base for indirect tax was there. And accordingly, the indirect taxes were imposed at several levels by the state governments, by the central government, and it resulted in huge mobilization of taxes. But there were certain obvious fallouts on such heavy reliance on indirect taxes. The indirect taxes resulted in a price rise for the commodities and services. Because of this price rise, there was a demand constraint for these goods and services, and the market for the goods and services did not expand sufficiently, which proved to be a severe obstacle in the way of achieving higher industrial growth. But on the advantageous side, compared to the direct taxes, the cost of collection of indirect taxes was much lesser. Because for collection of direct taxes, a very large infrastructure was required to be maintained by the government, and for maintenance of this huge infrastructure, government incurred a very high level of expenditure, which was not there with indirect taxes. The period beginning with 1947 till early 1990s, to be more specific, till 1991, this period of near about 4.5 decades, was characterized by a sort of regressive tax system with predominance of indirect taxes and much lesser importance of direct taxes. But what was the result of such a tax structure on Indian economy? The high rate of direct taxes was very much demotivating for the entrepreneurs to make investments in India. So, and for the people earning incomes who had to pay such high rate of taxes, they engaged in high level of tax evasion. So neither industries were growing, investments were growing, and on the other hand, as has already been pointed out, the multiplicity of indirect taxes resulted in price rise of essential goods and services and constrained the demand growth and growth in market size, and thereby the growth in industrial demand. With such a tax structure in the background, in early 1990s, it was felt that some urgent reforms were necessary to have a reorientation of the Indian tax policy, because it was felt that the tax system should be made more progressive. the emphasis or the reliance on indirect taxes should be reduced. The direct taxes should get more importance, and the tax system should be such that it would result in adequate revenue generation for the government, but at the same time, it should motivate the investors and the laborers to increase investments and labor income. So, with such objectives in the background, the reforms in Indian tax system was initiated in early 1990s. And the first step in the reforms process was the formation of a committee under the chairmanship of Dr. Raja Chelaiah, an eminent fiscal expert. And the committee came to be known as the Chelaiah Committee. The Chelaiah Committee, after a detailed study and analysis of the Indian tax structure, submitted a report in 1992 which contained some very, very important recommendations for the Indian tax system. There were very detailed recommendations made by Chelaiah Committee as to how the tax base could be broadened and the gradual lowering of particularly the income tax and the corporate tax rates. Now, we would look the broad features and try to analyze the orientation of Dr. Raja Chelaiah Committee's recommendations. Chelaiah Committee recommended that the corporate tax rate should be brought down significantly, and the difference between the rates of the domestic companies and the foreign companies should not exceed 10%. On the other hand, the Chelaiah Committee also recommended that the income tax rates should also be brought down, and the difference in the tax rates at the entry level and the highest marginal rate of taxation, that should also be narrowed down significantly. Besides, one very, very significant recommendation made by the Chelaiah Committee particularly for boosting up investments in the share market, in the mutual fund, was that the policy of inflation indexation. The Chelaiah Committee made a recommendation that the long-term capital gains tax should be inflation indexed. That is, if a person makes an investment in the mutual fund for a long period, say for a period more than a year, and he derives capital gains from his investment in that mutual fund, then there should not be a flat taxation of the entire capital gains. Rather, this should be weighed for the rate of inflation that has taken place every year, and that inflation rate should be subtracted from the profits made, and the taxation should be made on the real rate, that real gains which has accrued to the investors. So this was felt that such an inflation indexation of taxation of long-term capital gains tax would greatly encourage those investors who want to put in their money for a long period of time in the mutual funds. The Chelaiah Committee also made certain significant recommendations pertaining to the indirect tax system of India. One of the very key recommendations of the Chelaiah Committee was that the multiplicity of customs duties should be brought down. There should be a simplification of the rate structure and a rationalization of the rate structure. Besides, the excise duty format and the excise duty structure was also to be simplified to considerable extent. And the Chelaya Committee also proposed an ad valorem type of excise duty for different goods and services. Now, the Chelaya Committee submitted its recommendations in 1992, and after that, slowly, gradually, its recommendations started to be implemented. And particularly the direct tax structure in India was really getting transformed to some extent. Now, to work upon the nitty-gritties, to fine-tune the tax system further, another committee was, rather a task force, was constituted under the chairmanship of Dr. Vijay Kelkar, and that task force also submitted its recommendations, which came to be known as the Kelkar Committee recommendations. Kelkar Committee's recommendations pertaining to direct taxes has two very key areas. One was that Kelkar Committee, for the first time, recommended that the income tax exemption limit for individuals should be raised from Rs 50,000 to Rs 1 lakh. This was for general public, and for the senior citizens, the exemption limit should go up to 1.5 lakh. Besides, the Kelkar Committee also proposed a two-tier income tax rate structure. One was a tax rate of 20% that would be applicable for income earning from Rs 1 lakh to 4 lakh, and those who would be earning income in excess of Rs 4 lakhs, they will have to pay an income tax at the rate of 30%. So a two-tier income tax structure was proposed by the Kelkar Committee. But the Kelkar Committee recommendations had certain very important constituents, particularly with regard to the indirect tax system of India. And it was for the first time an idea of a nationwide comprehensive value-added indirect tax regime was mooted for the first time in the recommendations of a Kelkar Committee, because the Kelkar Committee suggested that the excise duty regime should be simplified and there should be a nationwide comprehensive value-added tax system that should be introduced rather as a form of excise duty. From the early 1990s till early 2000, or rather till the middle of the first decade of 2000, the Kelkar Committee recommendations and the Chelaya Committee recommendations served as the backbone of the India's tax system. And it was based on the framework created on the basis of the Chelaya Committee and Kelkar Committee recommendations that the Indian tax system functioned for near about 2.5 decades. Now, what was the impact of such transformations which took place as per the Chelaya Committee and Kelkar Committee recommendations on the Indian tax system? Definitely, the Indian tax system had a change in its orientation. The direct tax rates came down considerably, and a host of measures were initiated for broadening of the tax base. With regard to indirect tax rates, particularly the excise duty structure was considerably simplified with 3 applicable rates. There was considerable procedural simplification for the customs duty also. And all these resulted in a much improved tax revenue mobilization and better tax buoyancy for the economy. But this was still not enough. A lot remained to be done, particularly with regard to the indirect tax regime in India. And a move was initiated in this direction to bring about such changes, particularly in the indirect tax regime, so that the Indian tax system can be at par with the type of tax system followed in the economically advanced countries. And the landmark change came in the shape of launching of the goods and services tax, known as the GST, on 1st July 2017 through the 101st Constitution Amendment in the Parliament. Now, the goods and services tax is regarded as the landmark change in the Indian tax system. It is sort of a radical change which has never happened before, because this goods services tax has been formed through an amalgamation of 17 different types of indirect taxes at the central and the state level, and a host of cess which are imposed on such taxes. So it was a Herculean task through an amalgamation of such huge number of taxes. And the uniqueness of this GST was that it had a central component as also a state component. Both the center and the state imposed taxes on the same base. The central component of the GST came to be known as the CGST or Central GST, and the state component came to be known as the SGST or State GST. Now, at present, there are 4 different rates of GST: 5, 12, 16 and 28%. And the list of items which would fall under each of these specific rates have also been worked out. Only petroleum and alcohol for human consumption, they have been kept outside the purview of the GST, and for all other items, they have been brought under GST. But the point is, why GST has been hailed as a landmark change in the Indian tax system? What is so special about GST? GST is a multi-level, destination-based and a comprehensive tax which has been brought into force in the Indian tax system. Now let us analyze each of these components. It's a comprehensive. Why comprehensive? Because it has been brought into force through an amalgamation of 17 different indirect taxes. So it's a comprehensive one. It includes all those 17 taxes, and not only taxes, the different cess which were also imposed on those taxes. Now, multi-level. Now here we need to understand something. GST is actually a value-added tax. That is, this tax is imposed on the amount of value addition which is made at each stage, starting right from production, where the raw materials are getting converted into a product, to its packaging, then its transportation, where ultimately it reaches to the dealer and the dealer sells it to the customer. Now suppose rupees 1000 worth of flour has been purchased by the producer, and through a processing in the different machines, it has been transformed into breads, and those breads are being sold at rupees 1,500. Now here the value addition is 1,500 minus 1,000, because 1,000 is the value of the raw materials. Rupees 500 is the value addition. Now the GST, the applicable rate, would be on this rupees 500, the extra value which has been added at this stage. After the breads are made, then it goes to the warehousing. Now they stores it, they packages it, and then they sells it to the dealer at 1600. So they have added 100 rupees more value, and the GST would be applicable on these 100 rupees, not on 1600 rupees. So this is the uniqueness of GST. It is a multi-level, that is, at each level the amount of extra value addition which is made, the GST, the applicable rate, is imposed on that extra value addition, not on the entire value. And the third feature, destination based. Earlier the prevailing practice of indirect taxation was origin based. Now the GST is a departure from that. This is a destination based taxes. Suppose something has been produced in West Bengal, but that goes to Karnataka where somebody buys that. So the consumption destination is Karnataka. So the tax should be payable in Karnataka, not in West Bengal. So it's not an origin based taxation, it's a consumption destination based taxation. The GST would result in certain definite positive effects for the Indian economy. The first and foremost advantage of the introduction of GST would be doing away with the earlier practice of the cascading effect of double taxation. That is, a person who is buying anything, in most of the cases, had to pay double taxes. That is, taxes were paid once on the inputs which are used in a production of certain output, as also when the price for the final product is paid, then the taxes are again paid on the entire value of the produce. But the inputs have already been taxed once. Now in GST, through the system of provisioning of input tax credit, that is, the amount of taxes which has once been paid on the inputs, that should be credited to the person who is buying the inputs and which are undergoing through certain processes, and a finished product is again produced, and on the value addition which is made over and above the inputs, only on that value addition the tax would be imposed, not on the inputs, because the inputs have once been taxed. So this doing away with the double taxation is expected to result in a lowering of the product price. The consumers would definitely be benefited, because it has been estimated that at present the 25 to 30% tax burden is borne by the consumers, which they don't actually realize. But the introduction of GST has made the indirect taxes much more transparent for the consumers. The consumers now understand how much indirect taxes they are paying. Now, apart from this, doing away with this problem of double taxation, another very, very important positive effect of the GST would be creation of a national market, one Indian market. Earlier, if any a foreign investor wanted to do an investment in India, he was presented with a very, very messy indirect tax picture, because if he wanted to invest in state X, there would be a multiplicity of indirect taxes with different rates. In state Y, there would be another set of taxes with another rates, and that person gets confused that where to invest, how much taxes to pay. So there was a sort of competitive indirect taxing among the Indian states. But now, with the introduction of one single indirect tax, GST, which is applicable at the same rate for a particular product, across India, across all Indian states, any producer will have a firm idea that how much indirect tax is to be paid. So this integrates the Indian market into one pan-Indian market. And over and above, by doing away with this system of double taxation, the Indian products, both at the domestic level and at the international level, will become much more competitive because a lowering of the cost and a transparency of the indirect tax amount.